All right, welcome everybody. We're gonna give it a few seconds here so everybody can get logged in, and then we'll get started in just a moment. Okay, well, let's dive in here and get started. Thanks for joining us for another educational webinar on behalf of Pat Hung and myself. Hopefully this is informative and educational. So we're going to be talking about retirement income optimization and demystifying reverse mortgages. So as we go through the webinar, if you have any questions, feel free to type them in the Q&A box, and we will get to those at the end. So I'm going to start off by talking about retiring in today's world and risks to consider, and then I'm going to turn it over to my mortgage partner to talk about reverse mortgages and how they work. And then again, as I mentioned, we'll have a Q&A forum at the end. So type any questions in there and we'll get to them. So I recently attended a webinar and the speaker, in addition to being in the world of finance, also was a mountain climber. And he kind of shared a story that, or shared multiple stories that, inevitably when people hear this, they start to ask questions about it, and inevitably that turns to kind of the risks and the dangers of mountain climbing. And he shares that, a lot of the injuries or unfortunate deaths actually happen on the way down, which catches people by surprise. And if you think about it, when you start, doing a journey like that, your adrenaline's running, you're excited, you're looking forward to getting to the top of the mountain, then you summit, enjoy that period of time, and then you start heading back down the mountain. But at that point, fatigue and tiredness has set in. You're not necessarily as sharp as you were on the way up, and that's inevitably and unfortunately where the majority of accidents actually happen. And he tied this story into retirement planning and how most people focus on all the risks of actually getting to retirement. Making sure they're saving enough, getting nervous about the markets when they're volatile. But the reality is, once you've hit that summit, that peak, as we look at it, and retirement, and you start heading down the mountain, i.e. withdrawing money from your portfolio, there's actually more risk on that downside that most people don't realize. So today I want to talk to you about some of these risks and more importantly, how to mitigate them. So retiring in today's world is definitely different than generations past. Most people today don't have pensions, or if they do, they're not as lucrative. So retirees in prior generations, a lot of them didn't even have retirement savings above and beyond their company pension. And if they did, it was maybe a relatively small amount. And so given today's retirees are relying much more heavily on their investment portfolios, that poses some additional risks and things to consider. So unfortunately, a lot of those things we don't have control over. Obviously, markets, how long we're going to live, inflation, which is obviously a timely topic these days. But I don't want to scare you with all these things, but more to be aware of, and so we can make some educated decisions about the things we do control, mainly how much we spend, and strategies to mitigate these other risks that we don't control. So before we get into the strategies, I wanted to talk to you about that impact of how much we spend, which is a big one. And we all love a good rule of thumb. Financial advisors are no different. And a very popular rule of thumb in our industry is the 4% rule, which simply states that if you take out about 4% of your portfolio, adjusted for inflation over your lifetime, you should be okay. You shouldn't have any, even in kind of the worst of market environments, you should still still be okay. But obviously everybody's situation is a little different. Not everybody has the flexibility or the ability to just live off 4%. And so I wanted to share with you some numbers to show how those situations might change. And so imagine we have two retirees, both have $1 million at retirement, but the only difference is one needs a little bit more money than the other. So let's say one retiree, instead of that $4,000 or $40,000 a year off their $1 million, they need about $43,000 a year. And then so that's someone that needs a little bit more out of the $1 million. And then on the flip side, we have someone that needs a little bit less, say $35,000. And so what you see here on the screen, this is one example, and for all our clients on the line, you know that we write our plans and stress test your plans with 1,000 simulations. So this would be one simulation. And this shows you starting in 1960 with a traditional 60-40 portfolio, 60% stocks, 40% bonds, and taking out different withdrawal rates. So that dark purple line is right about that average rule of thumb 4%, and you can see your money lasts about 35 years. So that might seem like a long time, but obviously a lot of our clients were dealing with married couples. So when you add those two together, depending on how early they retire, it's not uncommon for people to need their money to last more than 30 years. So you can see in this scenario, that money runs out right at 35 years. And if we lower, or I should say increase that withdrawal rate to about $43,000 a year, that's that yellow line, you can see that it has a relatively or a pretty significant impact on how long the money lasts. It runs out about 7 years prior. On the flip side, for that more conservative spender that's only taking out about $43,000, you can actually see that's the gray line. Their portfolio doubles over that 35-year period, despite taking out all those withdrawals. And so when I share these numbers with people, a lot of times they're a little surprised at how such a small impact, 0.4% up or down, can have such a dramatic impact and a large variance between kind of their outcomes. So before we move on to talk about the strategies that we control, I wanted to introduce to you Dr. Wade Pfau, whose research these topics are based on. And although you've probably never heard of Dr. Pfau, he's pretty well known in the financial world because of all the research he's done on the impact of withdrawal rates and strategies to navigate these risks. So a big part of Dr. Pfau's research was, figuring out or looking at why did such small impacts in withdrawal rates have such a large impact in the long-term outcome. And what he found is that in that distribution phase, when you have those negative market returns, they actually have a much greater impact than when you were saving in retirement, or saving for retirement, I should say. Some of you may have heard of the term dollar cost averaging, and that's simply when you're saving in your 401k or retirement account. When that market dips, you're actually buying more shares, assuming you're investing a fixed dollar amount, and assuming the market comes back up, you were actually better off for that dip. Well, that dynamic works in reverse in retirement. So as your portfolio dips and you're taking money out of it, the portfolio is also declining because of the market, and that actually makes it harder for the portfolio to recover. So let's look at one of the strategies that Dr. Pfau, or a concept that Dr. Pfau has researched. And this is a strategy of what would happen if you could skip distributions during or after years where you had a decline in your portfolio value. So what I've shown here on this chart, and all these charts are actually straight out of Dr. Pfau's books, is we have that dark purple line showing that 4% to approximately 4% withdrawal rate. And in this environment, going out, this is actually not a really bad scenario. Some of our clients may be familiar with us talking about a bad sequence of return. I actually wouldn't consider this a bad sequence of return. The first year your portfolio had a meaningful drawdown was 1970, so 10 years into withdrawals, which is I would consider a pretty good order of returns. And so what you're seeing here on this chart is in the gray and turquoise lines, that's the impact if you simply skipped a distribution after you had a negative year. So in 1970, 1974, or 1975, those were your years of significant declines in your portfolio value. And if you had the ability to skip a distribution after those years occurred, you can see how much of a dramatic impact. So rather than running out of money at the end of 95, your portfolio is actually still worth between 750,000 and $1 million. And if you have the ability to skip distributions in all 3 of those years, that's represented by the yellow line. So it really does have a dramatic impact. But as you might be thinking, Casey, that's great. I would love to not take money out of my portfolio, but I still have to live. And so that's where, again, going back to Dr. Pfau's research, he's written several books on the power of skipping distributions in bad market years. And there's a couple of different ways to fund these skip years, but one of the ways that Dr. Pfau espouses is by using a reverse mortgage as a strategic planning tool, not necessarily as that kind of emergency parachute at the end. And so, reverse mortgages tend to be one of those terms like insurance that as soon as people hear them, they kind of, pull back a little bit. And I know there's a lot of misconceptions about those. So now I'm going to turn things over to my mortgage partner, Troy, who I've worked with for 20 years now. And I'm going to have him discuss some of the ins and outs of reverse mortgages, how they work, and we'll touch on some of the common misconceptions about them, and then we'll get into Q&A.
Thank you so much, Casey. I appreciate it. And just for your audience, I've been in the mortgage business over 20 years. I've been doing reverse mortgages for over 10. So certainly well-versed in both and happy to kind of go through this with you in a little more depth today. I'm trying to get this thing to advance, Casey. If you want to advance it for me, that'd be great. There we go. Awesome. So first and foremost, what is a reverse mortgage? Most people think of reverse mortgage as this financial parachute in the end. Hey, my plan didn't work, but at least I have some equity left. I'm going to, throw out my anchor and stop this process by getting a reverse mortgage so I don't have to worry about it anymore. We think of it as more of a strategy. We want to talk to you more about the strategic use of it because there's certainly a lot of things that once you understand kind of how money works and how this blends into your financial plan, you maybe will see this as more of a tool that can be used. So I'm just going to go through some of the simple facts. A reverse mortgage is a simple interest, non-recourse loan. It's important to kind of know that, and simply doesn't have any monthly payment required for that purpose. Things to kind of consider: clients still remain the owners of their home. The bank does not take over the equity in that property. They do not take over title of that home. So you get to retain as the primary owner of that home first and foremost. Secondly, there's a simple lien in a mortgage that's filed just like any other mortgage, just like forward loans are done. As the owner of that home in a reverse mortgage, you're still required to pay your property taxes and the insurance, and then of course any kind of HOA. But as long as you do that, the reverse mortgage will stay in place and take care of things. Number 4 says no monthly payment required. And then 5 simply says that it can be done on a single family home, a condo or townhome, or even a 2 or 4 unit apartment building, but it has to be the person's primary residence. So that's the main thing to keep in mind there. So you can kind of see there's an asterisk here. There are programs that allow seniors that are under the normal threshold of 62 years or older to do reverse mortgages, but those are on the proprietary, or we call the jumbo side of the reverse mortgage field. We're going to go into a little more depth on that, but there are roughly 27 states that have proprietary mortgages. Primarily, they're working on home values that are higher than what FHA might be able to utilize. And or a younger borrower that may need a reverse mortgage before they reach that specific age. Let's go on to the next one. Perfect. So 99% of reverse mortgage being done out there in the world are the HECM program, and HECM stands for the Home Equity Conversion Mortgage. This is the mortgage that is government backed, supported by FHA, and it's insured by the US federal government. It was created back in 1989, President Reagan era, and it has the FHA insurance that goes along for the ride. The FHA insurance is one of the things that makes the program expensive on the front end, but it also has a ton of benefits to you and your heirs in the case of when you pass and how that gets handled. So more on that in a little bit as well. And there's well over 1 million Americans. In fact, I think it's around 1.4 million Americans now that have utilized that HECM program. FHA product is the most popular by far, but the jumbo reverse opportunities are definitely plentiful here in LA. You can do a $4 million reverse mortgage on a $10 million property. It's quite amazing, where the FHA product is a much smaller loan, and we can go into more depth on that later. Let's go to the next one. There was a survey done back in 2017 of financial advisors that had been recommending reverse mortgages to their clients. And I find this interesting to kind of walk you through what are the 4 main common uses. Why are people doing these products? And I'll go into a little depth on each. You get a feel for kind of how that works. So the greatest reason, 68% of the respondents came back saying, we're just simply trying to eliminate the mortgage balance, eliminate mortgage payments, and that'll help the clients, preserve their lifestyle, it'll preserve their retirement plan, whatever it may be. So that's the #1 use by far. But in the process of doing that, there's a little tagline there. It says 60% of the people actually were able to create a line of credit in the process of doing so. Mathematically speaking, there's an algorithm that takes place behind the scenes, based on home value, based on your age, and a calculation gets done saying, okay, well, you have access to X amount of a loan for your property. And if you subtract out what you actually owe and all the costs, and there's a balance still left that you have access to, that becomes the line of credit. That line of credit has a really neat growth feature attached to it and allows you future access to equity in that home. The second use, and I'm going to go a little more depth on this, is simply for line of credit purposes. So the advisor, told the client, hey, let's go do a reverse. We want to have a standby line of credit. And this is really where that strategic use kicks in, because when you establish a line of credit in the reverse mortgage HECM product, it can never be taken away from you. There's a lot of seniors in the last financial downturn that had gone out and gotten simply a regular old home equity line of credit, thinking that was their emergency fund, their access to cash if they needed it, only to find out that when the banks started seeing home values coming down, the banks froze all those lines of credit. In the HECM product, the insurance you're paying for up front to get it, and that non-recourse feature allows you to actually keep that line of credit regardless of what's going on for property value purposes. So really neat in that regard. And then also the growth component of the reverse home equity line of credit. When you establish a line of credit, let's say you get a line of credit of $200,000 and it's unused, right? And that's great. It sits there, a balance available to you. Any unused portion of that line of credit has a growth feature to it that allows it to grow at a rate of the current rate of that loan plus 0.5%, which is the mortgage insurance. So if you have a $100,000 loan in year 1, by the end of year 2, now you have maybe $107,000 available credit to you. And it just keeps growing like that over time. And of course, you're not paying any money on that line of credit, one, because it's a reverse mortgage in the first place, but we're also talking about the unused portion for your future use. So really neat in that regard. The next response back, the 11%, was monthly payment. And I'll just be clear on what that basically is. So this isn't just elimination of monthly payment. This is actually a creation of a tax-free income stream from the home to the homeowner. So again, that calculation gets done saying, Mr. and Ms. Smith, you have access to X amount of equity in the property. You can have a lump sum, you can have a line of credit, or you can set up a monthly payment so your home pays you an income every single month from that point forward. They call it a 10-year payment. It doesn't mean 10 years. It's for your life and the life of that loan. So there's a calculation as to what that amount is, but that's a very, very common use and a really neat one from a planning perspective, because now from this point forward, you have that income coming in. Again, as long as you live in the home, it's your primary residence, and you're maintaining the property, they can never take that away from you. The last one, and it's actually a very small percentage, but this one's growing quite a bit, is to purchase a new home. People are usually shocked that you can actually buy a home using a reverse mortgage, but it's certainly something you can do. And then there's a number of reasons for doing this. It really is a leverage tool. But just to give you a quick example, I have a client here locally that just had a baby, and it's the first grandkid for the grandparents who live in Ohio. And so they really want to be close. I don't blame them. Like, why not be close to your grandkid and do all that stuff? But it's really hard to sell a home in Ohio and expect to get really much of any of a home here in California because our prices are so much higher. So in this sense, they're selling the home back in Ohio. They're getting about $400,000 in cash. They don't really want a mortgage payment. So when they come out here and look at $400,000 properties, it doesn't, there's not much of a home they can get. But by using a reverse, we give them the leverage. So with $400,000 down and using a reverse, they can get roughly a $650,000, maybe even $700,000 home, depending on what the rates are, and still achieve the, getting the new home goal, but also at the same time, not having to make a mortgage payment on that. So really neat strategic use and some other ways to do it. This loan is kind of a Swiss Army knife. There's lots of ways you can put it together. And that's why Casey and I do work together so closely with clients that are considering these to set it up the way that makes the most sense for their big picture portion. So again, back to just simply the most used reason is just to eliminate the mortgage and get that line of credit.
All right, thanks, Troy. I appreciate that. And so now we're going to move on to some questions that we've gotten. We wanted to keep this somewhat brief, or not drag this out to an hour-long presentation. So both of us really just kind of touched on some real high-level stuff. Troy, I got a few questions that have come in for you on the reverse side. Obviously, that's again one of the big questions people have. First one, big one. How much do reverse mortgages cost to implement that? And kind of maybe tie that in. I'll add a little bit on there. Like, when wouldn't you use a reverse, and why?
No, great question. The cost of reverse do vary based on the value of the home and the amount that you're borrowing, of course, and interest rates obviously make a difference as well. We always say, let's say a ballpark figure, right? The most expensive part of that reverse mortgage is the upfront mortgage insurance, and it's basically a 2% of the value of that home. Again, if your home's worth $4 million, FHA is going to look at it as a little bit over $1 million property. That could be $20,000 in mortgage insurance right there, plus regular costs. So ballpark figures, maybe between $15,000 and $30,000 in actual closing costs, just determined by value of the home and the amount of the loan that's getting done. With that said, the mortgage insurance, of course, is the largest cost, but also has the largest benefit to the client in the sense that it's a non-recourse loan, right? So if you looked at the value of that line of credit and the line of credit growth and know that it can't be taken away and that it might allow you to skip, your distribution 1 year or 2 years or whatever it may be for the financial planning purposes, the costs obviously, benefit outweigh the costs, I guess is one way of saying that. The mortgage insurance also insures your heirs so that if you were to pass away in the situation where more is owed on the home than what the home is worth, the heirs have no liability and the bank can't come after other assets in order to recoup that loss. The mortgage insurance basically kicks in and saves your heirs as well as the bank from that loss. So that's kind of the reason behind it and some of the costs behind it. Does that help?
Yep, awesome. Actually, given your answer, I'm going to tack on one more question because I probably have it here in the queue as well. Another big concern I think clients or anyone has when they hear the reverse mortgage is they feel like, I'm giving up my house, and what's going to happen when I pass? Do my heirs, am I giving it away and giving all the equity away, or so can you describe that process? I know that's a very common question is what happens when someone passes away, and how do their heirs, what happens if they want to sell the property? What happens if they want to keep the property? Could you describe that in a little bit?
Yeah, absolutely. And it surprisingly works a lot like any mortgage does from this regard as well. So let's say you get the reverse from the get-go and it's the, paying off a balance plus line of credit. Obviously, if you're not making payments, that loan balance will grow over time. And so in order to figure out what's owed, you as the owner of the home are going to get a statement every month that shows exactly what's going on and what's being added to that loan amount. That's fine. But like for your heirs will, acquire title to the property. They will, in the process of doing that, establishing that they have the rights to do it, let's say, they will contact the lender and say, what's owed? The escrow company calls for a loan payoff, and they just do the calculation. If in fact that home is upside down, then they just contact the lender and say, hey, this is upside down, but we actually have an option here of still buying it. Technically, they're allowed to buy that house at 95% loan to value. The insurance kicks in and allows them to do that. It's kind of an interesting, weird feature that's there. But if they have no interest in the property whatsoever, they can just let it go. It's basically like a strategic foreclosure, if you want to call it that. But that obviously is only in the instance where more is owed on the home than what it's worth. It's a rare instance, actually. If you think about the way the reverse mortgages are done, they're very conservative. And an old rule of thumb we'd say would be, the bank will allow you access to roughly 50% of the value of your home. So if you owe, if you have a $500,000 home, you'd be able to get roughly a $250,000 mortgage. That calculation doesn't exactly work right now because rates are slightly higher, so the percentage is slightly lower, but gives you that idea. Generally speaking, you have a loan worth, let's say, half the value of the home going up with interest every month, but you still have a home at full value appreciating. So more often than not, there is equity left. And so simply the kids contact the bank, they can go through the sale, or they can actually take it over themselves with refinance. They have to notify the bank right away upon the person's passing, just to let them know, hey, this is what our intentions are. And then technically they have 6 months to get it sold, but if they need more time, or to take over ownership, whatever it may be, but if they need more time, the bank will extend up to a full year for them to deal with what they want to do with that property.
Awesome. That's helpful. Let's see here. A couple more that have come in. Do both spouses have to be, let's see, this was written. Yeah, do both spouses have to be 62, or how does that work if you have one above 62, one below 62?
So the answer is no, technically. But when one of the homeowners is under 62, they basically alter the amount they'll give you access to, right? So back to my other number. If it was 50% at someone that's 62, and someone is maybe 55 that wants to be on that loan as well, the bank will draw down a little bit more to the access point. So maybe you're only going to be access 40% or 35% of the equity in that home. So that's the way they do it. They technically have a term for it's basically like a non-borrowing spouse, and there's an exempt non-borrowing spouse and there's a non-exempt borrowing spouse, and it has to do with whether or not they actually live and occupy that home, because sometimes you'll have married couples that, hey, one lives in Florida, one lives here, and it just is what it is. And so there's certain rules for that, but technically speaking, no. Whether it makes sense to do it before both people are 62 is really the numbers. We can run the numbers and see if it makes sense based on what they owe, because you certainly don't want to write a large check at closing simply because one person is younger, if you have the wherewithal to kind of keep going a little bit longer to get both spouses at 62 or older.
Awesome. Well, looks like I have one last question here, and I'll actually tackle this one. The question is is there a difference between putting the reverse mortgage in now when you maybe don't necessarily need it versus maybe waiting for that, to see if you get that, that negative market environment that seems harder to get out of? And I didn't include this slide on the presentation. Again, I wanted to be cognizant of everybody's time. And there's tons of research that Dr. Pfau has put out and in his books. And one of that analysis is kind of looking at over time, what's the difference between putting a reverse mortgage in as soon as possible versus waiting till, he really did the analysis on kind of using the traditional way people thought of reverse mortgages. I'm just not going to get it unless I need that emergency parachute. And he looked back over a number of rolling 30-year periods to see, what scenarios would have benefited getting the reverse mortgage as soon as possible, and what scenarios would have benefited just waiting till and using it as that emergency parachute. And really, the reason why there's an advantage to putting it on early is, as Troy mentioned, the line of credit that is going unused continues to grow. So if you start out with that $100,000 or $200,000 line of credit, that might grow to $400,000 or $500,000 over a long period of time, depending on what interest rates are. So that his analysis found that it's really more advantageous to put that on as soon as possible. There were some periods of time where waiting till the last moment actually made more sense. They tended to cluster around periods that were in the 1980s when interest rates were in the double digits. It's just kind of a unique environment. So I kind of look at that as an outlier. But so you can look at it both ways. But the nice part is, as Troy mentioned, that line of credit kind of grows guaranteed. And unlike a home equity line, as he mentioned, it can't ever be taken away from you. So you could use a home equity line as that asset to draw on, but typically those are only 10-year draw periods. Obviously, you still technically need to make a payment, although you could make it out of the home equity line itself. So you wouldn't run into a problem unless it was actually at the limit. And then obviously, as Troy mentioned, that back when we went through the financial crisis and the housing crisis, a lot of people, myself even included, were surprised to hear that banks could just freeze your line of credit and not give you access to it. So, and with that, looks like that is all our questions. So again, thanks Troy for sharing all the information, and hope everybody found this helpful. There will be a recording sent out after, so if you want to re-listen to the webinar, I know we threw a lot of information at you in a short period of time. So you can go ahead and keep an eye out for that email, and we'll see you in the future on our next webinars. Thanks.